Welcome to my channel. I'm Scott, and in this video I am going to show you how the income statement, balance sheet, and statement of cash flows are connected together. When most people want to learn about a company's financials, they usually listen to analysts or the company themselves. But the problem is, those people usually put a positive spin on things, or maybe a negative spin on things. So you don't always get the true picture. But if you could look at the financials yourself, you get all the information. So I created a fictitious company called Slippers Beyond Retail. We manufacture and wholesale slippers. Right now it's a private business, so the first thing you do when you start a business is you add cash. So you can think of this as your business. You're going to add $5 million of cash to start your business. So we increase cash $5 million. On the balance sheet, assets have to equal liabilities plus equity. So we can't put $5 million in liabilities, so we have to put in equity. We're going to put it in owner's equity, $5 million. Every transaction has to be recorded in at least 2 accounts. When you record transactions, you have to use the balance sheet or income statement. That's why they call it double entry accounting, because a debit has to offset a credit. Let's do the second transaction. We're going to buy $1 million of slippers from our vendor. The company is called Slippy. They're going to just give us $1 million of generic slippers, and we're going to pay cash. So we'll reduce cash by $1 million. We'll just send them a check, and then they'll send us $1 million of inventory. We reduced cash by $1 million and increased inventory by $1 million. So both entries were contained in the asset section. What we do as a company, we take these generic slippers and make them really nice, then sell them at a markup. Walmart wants to buy our entire inventory. We're going to sell the $1 million of slippers we bought for $2 million. Since we're getting rid of the inventory, we take it off the balance sheet and put it onto the income statement and cost of revenue. See, the balance sheet doesn't balance anymore because that $1 million that it's off is on the income statement. At the end of the year, we have to zero out the income statement and transfer over net income to retained earnings. So that's a double entry. So this $1 million will travel down to the bottom of the income statement, then get put into the equity section in retained earnings, and then our balance sheet will balance. And the reason we put $1 million in cost of revenue is because that's how much it cost us to buy the products to generate the revenue for this sale. So Walmart is going to send us $2 million in cash. So we'll add $2 million to cash, and then add $2 million to revenue. We have 10 employees, and each employee gets $50,000. So payroll is $500,000. So we have to minus $500,000 from cash. That $500,000 goes onto our income statement, and that goes into cost of revenue because that's part of the cost in order to generate the revenue. Now we have to pay taxes, so I'm just going to give a 20% tax rate. So we pay $100,000 in taxes, so we have to minus $100,000 from cash because we have to send that money to the IRS. Now every transaction for 2020 is complete. Let's do our statement of cash flows now. The statement of cash flows is broken out into 3 sections: cash flow from operations, cash flow from investing, and cash flow from financing. We're going to add $5 million in cash flow from financing. Whenever your company gets financing, whether through debt or equity, goes into cash flow from financing. If your company gets money from sales of its business, that goes into cash flow from operations. So the way you calculate cash flow from operations, you start with net income. Then to calculate cash flow from operations, you have to add back the non-cash items on the income statement. There weren't any non-cash items. So the $400,000 is our cash flow from operations. When the year first started, we had 0 in cash. And now that the year is over, we added $5.4 million of cash. And you can see that's our cash balance currently, $5.4 million. $400,000 from cash flow from operations and $5 million from cash flow from financing. Our free cash flow is $400,000, which is equal to our net income. That's not always the case. Sometimes free cash flow is more than net income, sometimes it's less. Now to close out 2020, we have to zero out the income statement, so we have to take the $400,000 and transfer it to retained earnings. We also have to zero out the statement of cash flows. The balance sheet is ongoing, we never have to zero that out. So you see the balance sheet at the end of 2020, that will be what it looks like in the beginning of 2021. So 2021, we're starting with $5.4 million of cash, $5 million of owner's equity, and $400,000 of retained earnings. You see it says owner's equity, because we're a private company. When we go public, which is next year, this is going to say shareholders' equity or stockholders' equity. Let's do our first transaction. We're going to buy $5 million of slippers from Slippy. So once again, we're going to pay all in cash. So we're going to take $5 million out of cash. And we add $5 million to inventory. So in this transaction, the debit and credit happen in the asset section. Once again this year, Walmart wants all our inventory. So we have $5 million of inventory. Even though we paid $5 million for the inventory, we're selling it to Walmart for $10 million because we made the slippers really nice. We added designs, we added colors, and that's why we're able to mark it up. You could think of the balance sheet as like a warehouse collecting dust just sitting there. When you actually move something from the balance sheet to the income statement, that means you actually sold a product and sent it to a customer. And now you could book the entire transaction onto your P&L. So we're going to take $5 million out of inventory and put it into cost of revenue. We're charging Walmart $10 million, so we're going to book that to revenue. Once we ship the slippers to Walmart, we have to book the revenue, even if we don't receive any money. In this case, Walmart's going to give us $5 million in cash. Let's add $5 million of cash. And the other $5 million they're going to pay to us in the future. So they're asking us to extend credit to them. And we're pretty comfortable extending credit to Walmart. We know they're going to have the money to pay us, even if it takes them a few months. Now we have to add $5 million to accounts receivables. So you can see our balance sheet is off $5 million. And you can see we have $5 million in net income. That's going to get transferred to retained earnings at the end of the year. So we do balance at this point. Now we're going to buy a slipper making machine for $1 million. That'll help us make slippers even faster. So we send a check for $1 million to the machine manufacturer. So we'll reduce cash $1 million. And now we have to add $1 million to property, plant, and equipment. So we made a transaction where $1 million left our business and someone sent us $1 million machine. So why don't we report the entire $1 million expense onto the income statement? Because for property and equipment, you depreciate the asset over time. Because if you put the entire $1 million expense onto the income statement, that would make your net income look really low for 2021. The machine has a useful life of 5 years. So you're spreading $200,000 a year over 5 years. So you book $200,000 of depreciation onto the income statement. And then you have to add $200,000 to accumulated depreciation on the balance sheet. Accumulated depreciation is a contra asset account. So it acts the opposite of a regular asset account. So if it has a positive balance, you actually minus it. So this brings down our assets. So we bought the machine for $1 million. We depreciated $200,000. So the value of the machine at the end of 2021, according to our balance sheet, is $800,000. Let's pay our 10 employees $50,000 each. That's $500,000. That goes in the cost of revenue because they're the ones who made the slippers. And now we have to minus $500,000 from cash. Double entry accounting. Every single transaction has to go into at least 2 accounts. Now let's pay our taxes. We're going to pay 20% of our operating income. So $860,000 in taxes. We'll minus that from cash. We have to send that to the IRS. Now let's do our statement of cash flows. First, we have to calculate cash flow from operations. We start with net income. And then we have to add back the non-cash items on the income statement. So we have depreciation of $200,000. Back in 2020, we had nothing in accounts receivables on the balance sheet. At the end of 2021, we have $5 million. So that means accounts receivables went up $5 million. When accounts receivables goes up, cash goes down. So that's negative $5 million on the statement of cash flows. The reason it's negative is because we didn't receive the cash for that transaction. We're going to receive it in the future. We also bought a machine for $1 million. That goes into CapEx. And we had nothing in cash flow from financing. You see at the end of 2020, we had $5.4 million of cash. And now currently we have a little over $3 million in cash. So our cash balance decreased $2.36 million. And you can see that's our change in cash. Change in cash is the sum of cash flow from financing, cash flow from investing, and cash flow from operations. This is a good check so you can reconcile the numbers and understand it better. So our free cash flow is cash flow from operations minus capital expenditures. So we actually had negative $2.4 million of cash flow in 2021. even though we reported a $3.4 million profit. So if I was an investor looking at this company, I would look at their 2020 financials, and I would see they had $400,000 of net income and $400,000 of free cash flow. Now I would look at 2021, and they grew a lot. They have $3.4 million of net income. But I'd be scratching my head, why did they lose $2.4 million of cash flow when they did so much better than 2020? So I would look at their cash flow from operations and their CapEx. They did spend $1 million in CapEx in 2021. That is part of it. But still, why do they have such a big negative? And when I see they extended $5 million of credit to Walmart, so I feel pretty good about this as an investor. I'm pretty confident that Walmart is going to pay its invoice. Even if sometimes Walmart does take a long time to pay its bill, I know they always pay. So at the end of 2021, we need to zero out the income statement and the statement of cash flows and transfer the $3.4 million from net income to retained earnings. And now our balance sheet balances. Now to start 2022, our balance sheet should look exactly like this, and all the numbers in the income statement and statement of cash flows will be zero. Now let's get started with 2022. So on the very first day of the year, we have no sales, so that's why everything is zero on the income statement and statement of cash flows. You can see up here it says public, so we're going to IPO this year. And I changed this from owner's equity to stockholders' equity. When we go public, there's not an individual that owns a company or a group of individuals. The owners of the company are all the stockholders. So the first transaction of 2022, we received $5 million from Walmart from what they owe us from last year. So let's increase cash $5 million. And now we can zero out the accounts receivables. Now we're going to buy $10 million of inventory on credit from Slippy. Slippy feels pretty comfortable extending credit to us since we've been pretty good customers the past couple of years. So we're going to add $10 million to inventory. Now we're going to add $10 million to accounts payable. Since we owe him $10 million, accounts payable is a liability. Once again, Walmart wants to buy all of our inventory. So we zero out inventory and we put that on cost of revenue. And once again, they're going to pay half in credit, half in cash. So we're charging them $20 million. So we're going to put $20 million on revenue and $10 million in accounts receivables and add $10 million to cash. Remember, we always mark up the inventory 100% because we make the slippers really nice. We're going to pass through another $200,000 depreciation for the machine onto the income statement. And now our accumulated depreciation is up to $400,000. So why do we break it out like this? Why don't we just put one line item, $600,000? Because if an investor was looking at the balance sheet, they would see how much we originally paid for the machine and how much we depreciated it. This just provides the public more information about your assets. Now we're going to IPO. We're going to sell 10 million shares at $5 each. So that's $50 million in cash we're going to get from the IPO. So let's add 50 million. When companies sell stock, they usually assign a par value. It's usually an arbitrary number just to keep track of the number of shares in the market. It's usually like 1 penny or maybe even 1/100th of a penny. So I assigned a par value of 1 penny per share. So 10 million shares times 1 penny equals $100,000. And that's going to go into common stock. If you ever see common stock on the equity section of the balance sheet, it's really low. Common stock is not the actual value of the stock in the market. Like I said, it's just a placeholder to keep track of the shares. And now additional paid in capital is how much money the company raised by selling stock. And we're going to put the remaining $50 million into additional paid in capital. So $49,900,000. So all future capital raises would go into additional paid in capital and a small amount in common stock. That's how you can track how much money the company raised from selling stock. But if they buy back stock, they may reduce additional paid in capital or report treasury stock. That's a contra equity account. I didn't do stock buybacks this video, but maybe next video I'll do that. So each shareholder bought the stock for $5 a share. If the stock goes up to $10 a share next week, that doesn't really benefit the company. And if the stock goes down to $1 a share, it doesn't really affect the company either. Because right now Walmart buys from us. It's not like if our stock goes up, Target will stop buying from us. Maybe Target will buy from us if we send them samples and they really like those samples, and maybe they tried to sell them to their customers and they sold out really quick. But retail stores don't really care where our stock price goes. There are some minor benefits from the stock price going up. If the people running the company own stock, they'll benefit if the stock price goes up. Also, if we wanted to raise more capital in future years, If the stock price is higher, we have to sell less shares. And also if there's convertible debt out there, like if the stock price hits a certain point, the debt converts to equity. So we lessen the debt on our balance sheet. But that's really the only benefit. There's not much benefit to the stock price movement. So the stock price movement has no effect on our core operational business. We added 5 more employees, so let's pay 15 employees $50,000 each. That's $750,000. That goes in the cost of revenue since they're the people who make the shoes. We have to minus $750,000 from cash. We added an employee, an HR person, and we're paying them $70,000. So we minus $70,000 from cash. And we put their salary in SG&A, selling, general, and administrative expenses. We cannot put their salary in cost of revenue because they're not actually making the products. And now let's pay taxes. Our tax rate is 20%, so 20% of our operating profit. So we have to minus $1.796 million from cash. Now let's do our statement of cash flows. We start with the cash flow from operations section, and that starts with net income. Now we have to add back the non-cash items on the income statement. $200,000 depreciation. In 2021, our accounts receivables was $5 million at the end of the year. Now it's $10 million, so our accounts receivables went up $5 million. When accounts receivables goes up, cash goes down. So negative $5 million. And last year we had 0 in accounts payable. This year we have $10 million. When accounts payable goes up, cash goes up. Because accounts receivables is kind of like a loan. You're not receiving cash, you're receiving products. It doesn't seem to make sense because you didn't actually receive $10 million of cash. You just received $10 million of slippers. If you think about it, your cash actually should have went down $10 million, but it didn't because you bought it on credit. It will go down $10 million when you pay it next year, and then it will show up as a negative on the statement of cash flows when you reduce your accounts payable. We had 0 in cash flow from investing, and we have to put $50 million in common stock issued in cash flow from financing. Let's reconcile our cash. Our balance sheet at the end of 2021 had $3 million of cash. Now our balance sheet has $65.4 million. So our cash balance went up $62.4 million, and that's a change in cash, $62.4 million. That's a sum of CFO, CFI, and CFF. But free cash flow is cash flow from operations minus capital expenditures. It has nothing to do with cash flow from financing. So we generated $12.4 million of cash flow, even though we reported $7.2 million of profit. So if I was an investor, I would look at 2021, I would think, wow, they generated $3.5 million of profit, but lost $2.4 million of cash. Now the next year, they had $7.2 million of profit, which is great, their profit went up. But how did their cash flow go up so much? Their free cash flow was $5 million more than their net income. So I would look at the cash flow from operations section, and I would see it was mainly because of the $10 million of accounts payable. That increased our cash flow $10 million. And then there's a negative $5 million accounts receivable. So that's why our cash flow went up so much. So next year, when we pay the $10 million, that will bring down our cash flow. So it all evens out over time. If you look at the financials over a long time frame, 10, 20 years, things will equal out. But if you look at 1 year or 2 years, the numbers don't seem to make much sense because of all this accrual accounting. But as long as you can figure out the reason it's off, at least you can make a better investment decision. Now we have to move the $7.2 million of net income over to retained earnings. Now our balance sheet balances, and this is the end of the 2022 balance sheet. So the balance sheet will look exactly like this to start 2023. So in the beginning of 2023, our balance sheet looks identical to the end of 2022, but our income statement is blank and our statement of cash flows is blank because we just started the year. We didn't do any transactions yet. So the first transaction, we're going to receive $10 million from Walmart. That's what they owe us from last year. So we'll increase cash $10 million. And we'll zero out the accounts receivable. Now we're going to pay $10 million to Slippy from the money we owed him from last year. So we zero out accounts payable, and we minus $10 million from cash. Now we're going to buy $30 million of inventory on credit from Slippy. So he's going to send us $30 million of inventory, and we're going to book $30 million to accounts payable. This year, Walmart doesn't want all our inventory. They only want $20 million. And we're going to charge them $40 million. And we add $20 million to cost of revenue because that's how much it cost us. Now Walmart needs to pay us $40 million. But however they pay us, we still have to book $40 million as revenue. And they're going to pay us once again half in cash, half in receivables. So we'll add $20 million to cash. and 20 million to receivables. Now let's pay our 15 employees $50,000 each. We'll add $750,000 to cost of revenue, and we'll minus $750,000 from cash. We have to pay our HR employee $80,000. We raised their salary, so $80,000 to SG&A minus $80,000 from cash. Remember that $1 million slipper making machine I bought in 2021? According to our balance sheet, it has a carrying value of $600,000. But the machine is actually worthless. It's not worth anything in the market because they built a newer model and it's actually a lot cheaper and works a lot better. So the machine we have has zero market value. We couldn't get any money for it. So we have to remove property, plant, and equipment and accumulated depreciation and take that $600,000 and report it as an asset impairment. So we're reducing the value of an asset $600,000 and passing through the entire loss onto the income statement. That doesn't mean we have to throw out the machine. We can still use it for many years. It just has a market value of nothing. Because we have to reflect the assets in our business appropriately on the balance sheet. We can't overstate our assets. Let's pay our taxes. We had $18.6 million of pre-tax income. Our tax rate is 20%. So that's $3.7 million. We'll minus that from cash. Now let's do our statement of cash flows. So it starts with net income, $14.856 million. Last year, our accounts receivables was $10 million. Now it's $20 million. When accounts receivables goes up, cash goes down. And last year, our inventory was $0. Now our inventory is $10 million. When inventory goes up, cash goes down. And last year, we had $10 million of accounts payable. Now we have $30 million. When accounts payable goes up, cash goes up. So to calculate cash flow from operations, you have to take your net income, adjust for changes in working capital, and also add back the non-cash items on the income statement. So we passed through a $600,000 asset impairment. We have to add that back. Because that's a non-cash item, we paid the $1 million back in 2021. The company is doing well, so we want to acquire another company. We're going to acquire Sandals Beyond Retail, and we're going to give them $5 million for the acquisition. We're going to pay all cash. So we reduce our cash, $5 million, and we take their entire company's balance sheet and put it onto ours. They just have two things on their balance sheet. They have $4 million of inventory and $1 million of accounts payable. So we add $4 million to inventory, because we take their inventory, and we add $1 million to accounts payable, because we take on their debt. So the book value of Sandals Beyond Retail is $3 million. It's $4 million of inventory minus $1 million of accounts payable. They're worth $3 million, but we paid $5 million. So the $2 million difference is booked as goodwill. Goodwill is kind of a meaningless asset. It's just a plug to get things to balance. It's an intangible asset, so you can't touch it or sell it. But in future years, you can pass through goodwill impairment and reduce the value of your goodwill on your balance sheet and pass through a loss onto your income statement. Maybe I'll do that in a future video. Now let's add negative $5 million since we paid $5 million for the acquisition. Now let's see if our cash reconciles. So our cash balance at the end of 2022 was $65.4 million, and now it's $75.9 million. So our cash went up $10.456 million, and that's a change in cash. Let's also close out our income statement, transfer the $14.9 million to retain earnings, so our balance sheet balances. Now our balance sheet balances assets equal liabilities plus equity. So this will be the balance sheet to start 2024, and everything will be zeroed out. But let's look at the numbers. Our net income was $14.9 million and free cash flow of $15.5 million. So our free cash flow is actually pretty close to our net income. We did have a lot of changes, but the change in accounts receivables, inventory, and accounts payable wiped each other out, because two negative $10 million and a positive $20 million. And free cash flow is only cash flow from operations minus capital expenditures. There were no capital expenditures. Acquisitions are not part of free cash flow. I hope this helps you understand financial statements better. The more comfortable you are reading financial statements, the less you have to rely on others. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.